George of the jungle, strong as he can be.
Hey George, I've got my credit report right here that I got from annualcreditreport.com. You don't need to pull my credit report again to get a mortgage loan for me, do you? Yes, we do. And I'm going to explain that today in thecreditjungle.com. This is George Anderson. Thanks for coming in. And the mortgage industry uses a little bit different type of report. It's generated from the same data. It comes from the three credit bureaus, Experian, Equifax, and TransUnion. But there's some additional information that is put into it, and then it's formatted differently specifically for the mortgage industry. And it's referred to as an RMCR, or a Residential Mortgage Credit Report. And there are some unique features with that credit report. On my end, one of the unique features is it costs me, I think it's $59 now if I'm pulling it on a couple, to be able to pull that. And if I never close a loan for them, that's just cost of doing business. But most of the people that I work with, I will pull at either an individual or a joint tri-merge to use that as an educational object lesson to walk them through and see the information that's on there, because from my standpoint, the report's very, very easy to read if you understand, if somebody teaches you how to read it. Annualcreditreport.com and the ones that you get directly from the bureaus, good luck. I mean, I've looked at those and, they're more confusing than I even want to address on here. But so here's a couple of the unique features about the RMCR for the mortgage industry and why I think it's got some valuable information on it. So as I mentioned here, it's a tri-merge of all three bureaus. So it's one report, and it will report all the trade lines. So you may have a situation where you have an account, a car payment, credit card, what have you, that reports to TransUnion and Experian, but it doesn't report to Equifax. So if all you had was your Equifax report, you might have a negative item on there that's hurting you, or a positive item that's not helping you, that wouldn't be on there. Our report is going to show under each single trade line that you have, whether it's all three bureaus are reporting, one of them, two of them. Obviously, if none of them are reporting it, you're not going to know about it. But anyway, it's very easy to tell which of your creditors report to all three bureaus and which ones do not. So that's valuable. The other thing that it has in here is this little piece called trended data. Now, this is something that we don't use for decision making in the mortgage business yet. Back in 1996, when they started putting FICO scores on credit reports, I was around, I remember that. We just thought it was cute because, well, certainly they're not going to use these numbers as part of the decision-making process. Well, within 2 years, it became a part of the decision-making process. And I think it's going to be the same thing with trended data. So what's the difference between a FICO score and a trended data score? So the best way I know how to describe it is to think of the difference between a snapshot, a photo picture, and a movie. Okay? Your FICO score is a snapshot. It's a photograph based on the information that's on your credit report today. Then that's going to be your score. So if something changes over the course of the next week or month or whatever, if you have an account that got deleted, if you have a credit card balance that gets paid down, if you have a good trade line that hadn't been on there long enough to report and the next month it's going to report, then when I pull that credit report 30 days from now or whatever that time period is, again, it's going to be a new snapshot based on where you are at that moment. That's one of the reasons that it's fairly easy to manipulate a FICO score, is because you can very judiciously select a couple of things on there that that might be what I call high value targets. Like if we can get a pay to delete on that account, and if we can get 1 more month's reporting on this one, and if we can pay down that credit card, a combination of 3 things that may not require hardly any money at all, once we know that those changes have been done at the bureau level with the credit bureaus, I can go in and pull my new tri-merge, and I'm going to get brand new scores based on that. And it's very, very common to see people with 60 to 100 point increases within a 6-week time frame. Depends on what's on there, but that's a very common thing to do if I can coach somebody through it. Trended data, though, is, what is the direction of your credit? Are you getting into more credit card debt over time, and did you all of a sudden pay some off? Well, that may not mean that you're not going to go and rack it up again. So trended data looks at some different algorithms that, like I said, right now are not being used, but just wait, just watch. I think that's going to become part of the scoring component here. Just give it another year or two. But the other thing that shows up on the RMCR are fraud alerts. Somebody who maybe had, it'll state the year that the Social Security number was issued. So if you're dealing with somebody that's, that's 20 years old and their Social Security number was issued in 1978, okay, probably not a valid social. It'll say other names, aliases, different addresses that they've lived at. There's a lot of stuff in there that if you look at the credit report versus what the borrower is giving you, you might be able to see some mismatches on some things. And some of it is just simply oversight on somebody's part, or it can be a mixed file thing where they maybe have somebody that has a similar name, like they're a junior or something like that. But it alerts a lender that, hey, there's some stuff going on here that you might just want to verify. What was this address? What's this alias? Are there some things that we should be digging into further on the borrower? And then probably the last thing here is that we've talked about this in another video, but the mortgage industry does not use bank rate FICO. It doesn't use Vantage 3.0. It uses a proprietary FICO scoring model that's been designed for the mortgage industry. So again, there's a whole video that I put that talks about what are those different features on that. But an RMCR is a very helpful report, and from my standpoint, it's the best object lesson that I know to be able to sit down with somebody and let them look at the reason codes and figure out why what are the factors that are impacting their score, what are the creditors that are on there. It's a very all-inclusive report, going to capture a lot of material, very easy to read, and it's something that once people understand it, I believe that most people would have excellent credit if they knew what they had to do to get and to maintain excellent credit. And so that's one of the things that I enjoy doing with my clients. So thanks for coming into thecreditjungle.com today. This is George Anderson. Remember, you can push button, get mortgage professional, and I'd love to help you with your situation. Talk to you soon.